Chapter 8, New Institutionalism. The last chapter presented a school of thought premised on the idea that culture is the basic building block for understanding economic behavior. This stands in stark contrast to the individualistic approaches of the neoclassical and Austrian schools and leads to an analysis that focuses on institutions and patterns of behavior rather than personal motivations and rationality. But are these approaches mutually exclusive, or might some combination be possible? New Institutionalism believes that the answer is the latter. While it retains a neoclassical core with some elements of Austrianism, it includes a role for institutions. The basic idea is that though we are still studying scarcity and choice, we cannot assume perfect information or strict rationality. Transactions costs and uncertainties exist in the economy, and institutions are social constructs that can reduce or add to the associated costs. Similar to the argument made in the last chapter, institutions are seen as akin to rules of the game. They include formal and informal regulations, plus an enforcement mechanism. Someone's place of work may have a dress code, for example. It limits employees' choices, and it may be expressed explicitly in the form of written guidelines or implicitly, everyone just knows. And there are rewards for compliance and sanctions for rule breakers. The business itself, however, is not an institution, but an organization or a set of individuals with a common purpose. A university is an organization too, the common purpose being the creation and dissemination of knowledge. Many institutions exist within the university, including, for example, the process by which one earns tenure. There are written and unwritten rules and an enforcement mechanism. Institutions may be quite obvious, or it may require significant study to reveal them. In any event, the focal point of New Institutionalism is the institution, not the organization. Some institutions are quite helpful because they reduce our transactions costs. For example, let's say you have a share of stock to sell, but that no brokers exist. In that case, you will have to take it upon yourself to find a means of determining who might be interested in acquiring stock, advertising to them that you have a share for sale, monitoring their offers, indicating to whom you are selling it, collecting payment, and transferring ownership. That would be expensive and time-consuming. So you are willing to submit to the rules of a brokerage house and the government agency that regulates their activities, plus pay a fee in order to make it easier for you to sell your share of stock. Brokering can thus be a beneficial institution that reduces transactions costs. The situation is not always so rosy, however. Say in the brokerage example that the government regulators demanded bribes to approve transactions. This would actually add to the cost of doing business rather than lowering it. In this instance, people would certainly not choose to submit to this, but the power structure may be such that they have no choice. This discourages economic activity, and new institutionalists see underdevelopment as a function of issues like this. Whether or not useful institutions survive and harmful ones die is dependent on a number of factors. First, relative prices may play a role. This does not mean prices in the traditional sense, but in the context of the transactions cost reduction represented by the institution. Ceteris paribus, those that reduce costs are more preferred and are more likely to survive. Those that do not may fall into disuse and die. But the story is not that simple, for power, ideology, and path dependence also play a role. With respect to the first, it is sometimes true that those with the most power to change the rules are also the ones with the least incentive to do so. In the case of the government officials above, they have no reason to stop charging bribes. If they are the ones best positioned to alter the rules, then the rules will not change. If the customers or brokers have an economic or political means of effecting change, however, then the institution may evolve. Ideology also plays a role. Homo sapiens do not react with reality, but their impression thereof. They operate with a mental model that tells them how the world works and where they fit into it. An important part of this is the individual's ideology, their ideals, taboos, sense of justice, values, and so on. These are derived from the larger society and determine the conditions under which the formation and evolution of institutions takes place. Many aspects of medieval Catholicism clashed and hindered the development of capitalism. Japanese attitudes towards the body have limited the number of organ transplant surgeries there. Some religious doctrines condemn women to a lower status, and so on. Such ideological stances can be very powerful, and they act to enhance or inhibit economic development. New institutionalists also believe that path dependence must be considered. History is important. A common example is the QWERTY, Q-W-E-R-T-Y, keyboard. This layout is intentionally awkward because the goal was to slow typists as they used early and easily jammed typewriters. QWERTY accomplishes this by spreading out the most commonly used letters rather than concentrating them. As technology has made the jamming issue moot, one would think that changing the structure of the implicit prices would mean that a more efficient layout would be adopted. Not so, because so many people had already been trained and continue to be trained on QWERTY. The perceived cost of shifting has been considered too high to move to what everyone agrees would be a more efficient arrangement. In their study of the issues outlined above, new institutionalists are often led to examine the legal structure of societies and their property rights institutions. This is so because implicit in their analysis is the assumption that market-based exchange is generally superior to other forms of economic organization in fostering development. They believe that one of the reasons for the rapid technological growth of the West was that their institutions encouraged the evolution of capitalism, which then created incentives and opportunities not available in other systems. Within this context, a key question is how much control, as granted by formal and informal institutions, individuals have over all forms of property. One is more likely, they argue, to develop a more profitable means of growing potatoes when the lion's share of the benefit will accrue to you. A serf on a medieval manor, a member of a communal farm, or a slave have much less incentive, and therefore such systems are less likely to generate economic development. Unfortunately, say new institutionalists, history tells us that vested interest and path dependence are more often than not successful in blocking the development of more efficient institutions. People will embrace inefficiency if doing so allows them to remain true to their ideology. When tremendous inequities exist in a culture, those at the top of the hierarchy are both those most able to affect change and those least likely to want it. And if a society has evolved with a land tenure system that discourages efficient farming techniques, it is very difficult to universally adapt to a new one, even if everyone can see the benefit. In fact, all of these impediments are so difficult to overcome that new institutionalists believe that efficient institutional change is rare. Next section, application. The financial crises of 1763 and 2007 to 2008. For obvious reasons, economic history is a popular topic for new institutionalists, as is economic development. While to some extent this is motivated simply by curiosity, it is also true that they believe that studies of the past offer lessons for the present. Take, for example, Stephen Quinn and William Robert's study of the financial crisis of 1763. This paper focuses on the institution of merchant banking, wherein banks earn income by guaranteeing borrowers' debts. For example, say Merchant A wants to purchase goods on credit from Merchant B. Merchant B must trust that Merchant A will pay in a timely manner. If not, either the transaction will not take place or Merchant A will be charged a higher price. This is particularly problematic if Merchant A is not well known or is relatively small or new. In addition, this requires Merchant B to specialize in both the production of goods and services they sell and the evaluation of the creditworthiness of their customers. But if Merchant A borrows from a bank and Merchant B is paid immediately with bank credit, then two beneficial things happen. One, the risk that Merchant A defaults is shifted from Merchant B to the bank, an entity that is presumably better suited to evaluating and managing this. And two, while Merchant B must still worry that the bank may default, the bank will spend a great deal of effort both determining the viability of those to whom it lends and developing a reputation for reliability. This is therefore generally preferable to the risk associated with dealing directly with Merchant A. In this manner, transactions costs have been reduced. Amsterdam was an important source of such services in the late 18th century. During the 7 Years' War, 1756 to 1763, a great deal of extra business was generated for the bankers as they financed both governments and war-related businesses. The rising prices created by shortages helped firms earn income that allowed them to repay debt with relative ease. In such an environment, it was very tempting for banks to make an increasing volume of loans, because the more money you loan, the more interest you can earn, assuming the borrower repays. But when the war ended, so did the extra revenues. The fact that the banks financed their own operations via short-term borrowing created a very fragile situation. If you have no debt and experience a decline in income, it is possible that you may be able to weather the bad times by cutting back on expenditures. Those heavily indebted, however, have very few options in that regard. Their creditors expect, in fact need, since they are often debtors themselves, the regular payments you promised. When that flow is interrupted, bankruptcy may not be far behind. Given the interlocking nature of debts, default can spread very quickly from banks to firms and back again. This is precisely what happened in 1763. Prices fell dramatically after the war, and the unlucky first victim was Gebroeders de Neufel, a bank whose loans, say Quinn and Roberts, did not appear to be significantly riskier than anyone else's. Furthermore, the default that set things into motion was actually from one of Neufel's smaller accounts. However, the impact on the bank's own large weekly borrowing needs was decisive. This was the first in a series of events that led to a number of bank and merchant failures and economic disaster for Amsterdam and beyond. There are, argue Quinn and Roberts, a number of parallels with the events of 2007-8. In the more recent case, a boom in housing prices seemed to make mortgages and mortgage-backed derivatives a no-lose proposition. Just as with the inflated prices of the 7 Years' War, this led to sharp increase in financial market activity and a reduction in the caution exercised by lenders. But after the bubble burst, the result was the same as it had been more than 2 centuries earlier. When Lehman Brothers failed, again a firm whose operations did not appear to be particularly risky compared to the others, this sent shockwaves through the financial community. The interconnectedness of the debt structure meant that defaults spread quickly, and the overall level of economic activity declined substantially. What is most instructive, say Quinn and Roberts, is the comparison of the regulator's response. In both instances, governments made plentiful supplies of liquidity available, which calmed fears and slowed the rate of default. In 1763, however, banks were permitted to fail. In 2007-8, most were rescued. Quinn and Roberts consider these differences and run a number of simulations that look at other policy choices. In general, they conclude that the modern relief efforts were somewhat more successful. This, they say, was because policymakers offered liquidity not just domestically, but across national borders. Thus, they use this analysis not only to further our understanding of 1763, but to offer lessons for 2007 and beyond. Furthermore, the core focal point of their analysis was the institution of merchant banking and how it can serve to subtract from or add to transactions costs. Before leaving this section, note the similarity between some of the new institutionalist premises and those of the Austrians. They agree, for example, that economic agents must work with limited information and that they may struggle to determine which choice is best for them. They see markets as a key institution in solving this problem. And both perspectives also believe that market-based economies hold the greatest promise of development. Now, institutionalists, however, place much greater emphasis on the role of institutions and culture. Still, there's been some cross-fertilization. Next section, method. Because it derives from several disparate traditions, the new institutionalist method is a bit of a hybrid. On the one hand, it retains an Austrian neoclassical focus on the individual, scarcity, and choice. On the other, not only do institutions matter, but so do power, culture, ideology, and history. Thus, despite other similarities, new institutionalists do not generally engage in the a priori or as-if arguments typical of Austrians or neoclassicals, or, if they do, it is simply as a first step to lay out some behavioral proclivities. Like the institutionalists of the previous chapter, new institutionalists examine specific institutional structures, their origins, their evolution, and the nature of the societies in which they are found. Unlike institutionalists, they still see humans as rational after some fashion and as the ultimate forces of change. Thus, consistent with the Austrians, they believe that individuals, not institutions, act, and they therefore retain the former as the basic unit of analysis. Views of human nature and justice. Because of their neo-Austrian focus on the individual, they take a similar view of human nature. Individuals, though impacted by institutions, are the true agents of change in society. They create the institutions that then reduce or increase transactions costs. People are guided by self-interest, and they are quasi-rational, but they are naturally limited in the latter by their finite cognitive abilities and the always insufficient amount of information available. Also, like Austrians, new institutionalists view justice as outcomes that reflect the collective preferences of humans. Markets are not perfect, but they are the best means of making output and prices reflect this. Historically, it has been countries that embrace market exchange that have created incentives that generated the greatest economic development. They got the institutions right. Standards. Primary. First and foremost is the contention that institutions matter. Without such a premise, it would hardly be new institutionalist economics. It is universally believed that the formal and informal rules of an economic unit are decisive in determining its success. Within that context, human beings are viewed as operating with limited cognitive abilities and incomplete information, both of which contribute to the existence of transactions costs. But new institutionalism retains its neoclassical core in that it is seen as studying scarcity and choice. Secondary standards. Some new institutionalist economists self-consciously trace their tradition through the founders of institutionalist tradition discussed in the previous chapter. For example, Oliver Williamson cites the work of institutionalists John Commons and Wesley Clare Mitchell in a very positive light. On the other hand, others like Nobel laureate Douglas North deny that any such connection exists except by coincidence. Ironically, Duggar argues that North's work actually comes much closer to institutionalism than Williamson's. The extent to which formal mathematical modeling is embraced varies. Those dubbed the new institutionalists by Peter Spiegler and William Milberg make a point of using hyper-reductive mathematical models to represent these institutions as a means of explaining them. Their work still includes descriptive analyses of the phenomena in question, but the formal framework is considered to be the driving force. Others see techniques as supplemental, with the historical institutional descriptions as the key element. Common themes in new institutionalist literature include property rights, law, the historical evolution of institutions, and development. Entering such debates may enhance your chances of publication, but is not, of course, absolutely necessary. Contemporary activities. The main organization for new institutionalists is the International Society for New Institutional Economics. They hold an annual international conference, and their website includes a list of readings for those interested in new institutionalist economics. They also provide access to current job openings where the hiring institution may be open to their approach. While there is no journal devoted to new institutionalist research, their webpage maintains an automated list of related work. This school of thought is, in general, relatively young and still maturing and growing. Criticisms. Those coming from the more traditional approaches are likely to argue that, as with the school of thought covered in the last chapter, new institutionalism is not really economics. The issues discussed are of interest, but they are more properly the object of historians and sociologists. Perhaps ironically, institutionalists also object to a number of aspects of new institutionalism, while at the same time praising others. Most fundamentally, they argue that institutions exist not because of transactions costs and uncertainties, but because Homo sapiens are social animals. Even if people had complete information and were lightning-quick calculators of pain and pleasure, they would nevertheless live in packs. That is our nature. A core element of these packs is a set of shared beliefs, including behavioral norms. Therefore, institutions, including ideology, arise from our natural desire to be a member of the social group. Speaking of which, they would argue that new institutionalism's bias towards market-based solutions is not a result of dispassionate analysis, but really an unconscious reflection of the economist's own ideologies. The market is no more than one tool in our kit. New institutionalism, say institutionalists, need to let go of those last vestiges of neoclassicism. Final rejoinder. To the first criticism, new institutionalists, like the institutionalists, would respond that if laying out the specific conditions under which the financial crisis of 1763 took place is not economics, then what is it? We of course have a set of common premises guiding our analyses of each period, but there are sufficient differences between what happened 250 years ago and in 2007-8 to warrant a more contextual analysis. Indeed, there is no other way to explain these two events. To the institutionalists, they would say that the preference for market solutions is most certainly not an ideological bias. The evidence that such systems generate more efficient outcomes is overwhelming. The vast gulf between the post-colonial development of North and South America, for example, is due to differences in property rights and other legal and informal institutions that created a very different set of incentives and power structures. Generally speaking, where capitalism was successful, economies grew. With respect to the origin of institutions, new institutionalists would not deny the social nature of Homo sapiens. However, reliance on such general characterization of the phenomena provides no guide on how they evolve. The concepts of transactions cost, power, ideology, bounded rationality, and path dependence all offer powerful means of doing so. Final section, further reading. Perhaps the best starting place for new institutional economics is one of Douglas North's books or one of his survey articles. Ronald Coase's 1937 classic work on transactions costs is also very interesting and easy to read. Two New Institutionalist websites have extensive reading lists organized by topic. Look under Resources on the International Society for New Institutional Economics website and under New Institutional Economics at the Ronald Coase Institute website. Thank you.